All right, so welcome to today's webinar on liquidity and options. This is one of my absolute favorite topics. It's one of the things that during my proprietary trading career spent most of my time thinking about was liquidity. And I think there are a lot of different directions that we can go with this conversation. Today, we're just going to start mostly with an introduction, cover some broad measurement questions about liquidity, how to think about it, and tease some future topics. And I'll probably do a whole nother future webinar on incorporating liquidity into trading strategies and what that means for different strategy selection, what that means for implementation, and all kinds of good stuff like that. So, first of all, thanks everyone for joining here. If you've been here before, I think you know the drill, but if you're not and this is your first time, welcome. And I like to keep these things relatively open and engaging. So please find the Q&A in your Zoom and you can ask any questions there. I'll be happy to take them in line or at the very end, I'll also leave some time there. Typically, I shoot for about 30 minutes on these things to keep things light and fresh. And we'll be coming out with new webinars once about every 2 to 3 weeks. 3 weeks seems to be the cadence right about now. If anyone is interested in joining our Slack channel, please let me know. If you're a tape subscriber, you can log in directly from your dashboard. Otherwise, please feel free to shoot me an email. Whether or not you are a customer, client, or friend, I always appreciate getting questions and emails. So that email would be Mark, like my first name, at harvestedfinancial.com. Harvested, ED, financial.com. And shoot me anything. I love talking about options, and especially liquidity and options. So, because I am a financial advisor, if you've heard this once, you've heard it 1,000 times. This does not constitute financial advice. This is purely for educational purposes, and nothing in here is any kind of recommendation or solicitation for trades, trading advice, or trade recommendations. If you have any questions, please visit my website where you'll find the full terms and conditions. So now we get into the good stuff. And the question is, what is liquidity? And that's really what we're going to be focusing on today is kind of an abstract or a discussion of this abstract concept. And I think one of the best definitions I've heard, there are a lot of kind of angles to liquidity, but in general, liquidity is the measurement of the price of immediacy. So how big, at what price, and how quickly can a trade take place. The more liquid something is, the faster, cheaper, and in more size are those trades able to execute. And the less liquid, the more expensive that liquidity cost is on trading, both to get into a strategy and to get out of a strategy or trade. That's definitely an important thing to remember when we're talking about liquidity, is that you can't just think about it as a measurement that is, just at the time of entry. It's also, you got to think about liquidity at the exit time of your trade. And throughout the trade's life cycle, you need to be thinking about the liquidity because the liquidity is what is going to mark your position on a given basis. The less liquid something is, day over day, you're more likely to get more variation in those marks. So that could potentially, of course, have implications for margin and whatnot. So liquidity really affects every single trading decision that you will make. And as a market maker, we very much thought about our role in the marketplace as continually pricing that liquidity. And as a dealer, as someone who's willing to take the other side of every trade, you constantly had to think about what the given liquidity was in a specific strike, in a specific contract, what it was in the issue overall, and also what it is in the underlying and what it is in your ability to hedge. So we're going to talk about all those different components of liquidity, building up from underlying liquidity to per series to per ticker liquidity and options. So one important concept to remember with regards to liquidity is that it is a positive feedback cycle. By that, I mean that liquidity begets liquidity. I'm sure if you've been around the options markets or markets in general at all, you've heard that expression that the more liquid something gets, the more liquid it continues to be. And it also works in reverse, where the less liquid something gets, the more quickly it gets less liquid. And that's very much a reflection of the different participants and what they're observing in the market. And, to continue with the water analogy, it very much ebbs and flows over time. Liquidity isn't always consistent. Certain names like top tier ETFs like SPY and QQQ, yes, are always going to be very liquid, but the names that are getting the most liquidity in the markets change over time. So the different components of this feedback cycle we have here are the cost, the size, the speed, and the impact. And as costs expand, as liquidity costs, whether that cost is the friction of transaction cost, whether that's the cost in terms of the bid-ask spread, but that cost is going to contribute to the size that people are able to show on given orders and the width of the markets. And so the bigger size that gets shown, and that's going to ultimately reduce some of those transaction costs. There's going to be less slippage on larger orders. That's going to let markets trade faster. So speed becomes a component. And that's contributing to faster orders, faster execution, tighter markets, meaning being able to get an order done more quickly at less impact allows for more liquidity to continue to come in. We see that impact question too. So, how much a market will move on a given order? That we don't necessarily just think about liquidity as something that's a snapshot. That's an important thing to underline is that it can be a snapshot, and a lot of the measurements we'll talk about are snapshots of bid-ask spreads, of volumes and whatnot. But it's also an experience, that liquidity experience of any given order, how liquid is that going to be? How much impact are you going to have on the underlying market? And really, these factors are very much self-supporting. That the bigger size, faster things can happen, the less impact we're going to see. And that, of course, goes in reverse. So liquidity is very much something that is constantly coming and going. And particularly for dealers, for options market makers, adapting to those is very important, which means if you're on the buy side, if you're taking liquidity in general, which we all are, if you're not a market maker, you're taking liquidity for the most part. Monitoring how that's going to change is definitely going to impact what securities you choose to trade, what strategies you choose to trade within those securities, and even how you're going to make some of those execution decisions as you get into the trading itself. So, if liquidity is a cost, and liquidity and pricing of that liquidity is the job of market participants, what are the various different components here? And let's do this slide is designed to show proper accounting of all those different costs of liquidity. So, some of the different factors that are going into pricing, kind of that confidence interval, that market width, and the market size are broken out here. Inventory risk. That's a big one. That the requirement to hold positions for longer in less liquid securities is going to contribute to wider markets. If a dealer isn't able to easily get in and out of a trade and is forced to hold that on their sheets, that's going to reduce liquidity. If a dealer can or a dealer will be able to price liquidity much tighter, much cheaper if they know they're going to quickly be able to trade something offsetting or trade out of that very same option itself. With another cost that adds in there is the adverse selection element. That to some degree, this ties into inventory risk, that the more adverse selection risk there is, so whether that's a name that's got sparse information, whether that's, a name that has some pending news, the potential for adverse selection is going to widen the spread. It's going to reduce the liquidity. That when there is particular chunky, outsized, and better informed order flow, that is going to reduce the amount of liquidity available in a given security just because of that asymmetry that exists there. The volatility of the underlying and of the volatility itself, the vol of vol of any of the pricing inputs, really, the more uncertainty there is around any of those different components, and the more they're moving around, that's going to reduce liquidity in general. The look at a top tier name like SPY or QQQ. most of those inputs are fairly well hammered out. There's billions of dollars of capital trading around them any given day. So there's not a lot of volatility in the interest rate expectations for SPY or for the even the implied volatility within SPY. While that moves, it's not going to be as volatile as in a lower tier name. So more volatility of inputs, even in the underlying stock as an input, is going to create less liquid names, and it's going to be more difficult. Liquidity becomes more expensive. The hedging costs. So similar to that sort of inventory risk, one way that a dealer is able to trade out or manage their positions is selling back that same option or buying a like option or trading around it within the options marketplace. But they also do some of that hedging in the underlying stock. So to the extent that there's volatility in the underlying stock, to the extent that hedging in that name is particularly expensive because their liquidity is low, then that cost is going to trickle back up into options. So any security that is illiquid in the underlying is generally going to be illiquid within the options. There are even certain stocks that are difficult to hedge because they're an ADR or because they have some other complexity embedded in them. All of that is going to flow back into the options market, and we're going to see that reflected in the cost of liquidity. Capital usage is another question that we think about when we're accounting for how to price options. For example, deep options that both require significant delta hedges as well as more balance sheet to hold that position. Those are going to be less liquid. They're going to be less liquid because there's more stock to hedge. So back to that hedging cost question, but also because generally that's going to eat up some capital. And whether it's in a specific strike selection, whether it's in a specific name, that considerations about how much capital a market maker is using to support that position is going to go into the cost. Finally, along the lines of what we talked about a little bit with adverse selection, is the corporate action uncertainty. To the extent that there's ever any uncertainty about a stock split, about a merger, about a special dividend, or any specific event risk, any of that is also going to flow back into the cost of liquidity. More uncertainty across any of these factors is going to lead to a higher cost of liquidity. More resources, more risk leads to wider spreads, and immediacy becomes more expensive. So before we can really talk about options liquidity, I want to touch a little bit on underlying liquidity. And while this is a AI generated image, this was designed to be very similar to what the level two montages look like for underlying stock trading. So I have two different stocks here. I have ABC on the left and I have XYZ on the right. And these are designed to demonstrate what an illiquid stock in ABC looks like compared to what something in XYZ looks like. So we might look at ABC and see that the spread right there, the best bid is going to be this 87.41 number. And the best ask is 87.50. So that's that spread of 9 cents wide. We have the bid and ask, it's 9 cents wide, and we only have, in terms of size, each of these typically would represent 100 shares, a round lot. We'd see there are 500 bid at 87.41, 600 offered at 87.50. Compare that to a stock that's 8 times the price almost, 7 times the price, and 7.5. And there is a penny wide. We're 645.87 at 645.88. And there's real depth here. There's 4,700, 4,400 shares, not only on the bid and offer at a penny wide, but we also have these tighter decrements. So pretty quickly, you can see in this extreme example what high liquidity looks like. It's trading a much more significant average daily volume, but it's also got tighter spreads, more size in there. So to the extent that you need to move $10 million worth of stock in either one of these, the cost of that liquidity in the underlying is going to be far cheaper in XYZ than it would be in ABC. And we'll get in a little bit later on to some of the measurement of what that slippage and execution costs looks like. One thing I want to touch on too, because it's become such a hot topic in equities but the existence of dark pools and how they contribute to liquidity. And again, similar to what those lit markets that we were just looking at, the underlying liquidity, whether that's in dark pools, which now represent something like 60% of trading volume in underlyings, or whether that's on lit exchanges, the texture and composition here is really kind of that baseline before we can start talking about what liquidity looks like in options. So dark pools are essentially an exchange that doesn't have to publish its quotes. And equities have a special market structure that allows essentially anyone to register a trading facility, and they're allowed to consummate trades, match buyers and sellers with various different order types and mechanisms that might not be allowed in public markets, that might be opaque to both sides of the transaction that markets don't allow for. They allow for things like pings and peg order types and all or none and midpoint execution matches. There are all kinds of special rules that will exist in the dark pools, generally to lower trading costs and to kind of reduce that asymmetry such that no one's showing their hand, that orders only trade when they're fully executed. A lot of that opacity is actually very intentional and desirable for both sides of the transaction. Now, all of these customized matching algorithms and execution and slippage and kind of hiding your hand, so to speak, the argument is that they generally make markets more efficient. As I cited that stat, and I think a lot of the evidence that I've seen, they do that it is cheaper to trade in dark pools and the markets move less. Dark pools very much rely on underlying markets to lean on for some of their own pricing. So to the extent that too much starts moving to dark pools, maybe we get into a scenario where lit markets erode and dark pools then become less efficient without that. To be seen, but as of where they are now, I think they're driving a lot of efficiency in underlying, and they make for a great resource for options traders to get their stock executed. And that's been able to allow for the significant growth that we've seen in overall OCC, market-wide equity options volume. So we talked a little bit about sort of the dark pool structure, the lit exchange structure in equities, but options is very different. And there are a couple things that lead to why options liquidity looks a little different than the way we typically think about liquidity in underlying markets. So we're moving from a single instrument that has buyers and sellers matched up on both sides to fragmented listings, to different strikes, different expirations. In both worlds, there are, many different market centers where trades can take place, but we're getting almost to 20 different options exchanges that all sort of have NBBO priority, which means that there's a lot of different places where that liquidity could be and where the best ways to transact starts to get a little bit more complicated. But this point that I have in the center about dealer-driven markets, I think, is one of the biggest differences between the underlying liquidity and the options liquidity. That with an underlying, there are plenty of buyers and sellers of SPY on any given day in the equities market. Even looking at Apple, even looking at some of the other less common household names, that the buyers and sellers can match up because that's the activity in that name. It's not fragmented the way it is in the options, as I mentioned. And so that necessitates retail against retail or buy side against buy side isn't necessarily going to match up as easily when we look at options. That one person might want to trade the 380 strike in Apple, another person might want to trade the 270. And so while they both would be trading Apple stock and contributing to liquidity there, you really need a dealer to be providing quotes and incentivized to be providing quotes to allow for liquidity to exist in the options markets. And so, of course, they're built on these underlying markets, but because of the fragmentation, because of derivative sensitivities, options start to look very different, right? The convexity of an option is going to move much faster than an underlying potentially. So while underlyings can absolutely move and gap and jump, they're not going to have the same kinds of price swings on changes in volatility, interest rate, or stock moves that those underlyings do. So derivative nature, the fact that they lean on another market, that underlying, the variety and complexity of exchange mechanisms and order types, whether it's open outcry, whether it's on-screen liquidity, that there are so many different ways that people are trading options that structurally we have this environment where liquidity provision in options is all coming from the dealers, from the market makers. And I think they do a pretty darn good job. And I'm not just saying that because I'm a recovering market maker myself, but I think because we see a lot of really tight spread and efficient pricing and very high execution quality, which we'll get to in a minute, in the options market. And so options liquidity is fundamentally going to be coming from different dimensions, or it has different dimensions than just what we see in underlying markets. So here we have the options liquidity stack. And made up this chart where so far we've been dealing mostly with that underlying liquidity and what the derivative contract is based on. That's going to support all of the pyramid of options liquidity. The different series listings get into question of liquidity that we would describe as securities as being more and less liquid based on how many different strike listings are available. So highly liquid names are going to have dollar strikes. They're going to have weekly expirations. Less liquid names are probably only on a monthly calendar, and we might only be at $5 strikes, depending on the handle. The texture and availability and differentiation across all those different series listings is really going to be a contributing factor to liquidity. To the extent that there is good quoted spreads, which is the next one, on all of those different strikes. More series listings that fragments the liquidity, that spreads the dealer's capital across more different strikes, that might not necessarily be good for liquidity. So we want both that quoted spread and rich series listings to exist to really support good options liquidity. And then finally, at the top is what we'll call execution quality. And so that is the study and analysis of where executions take place relative to the market, relative to posted markets. And because there are so many price improvement mechanisms, and because retail orders are eligible for these price improvement mechanisms, they can actually, for the most part, trade within inside the NBBO. So there's this concept of actual displayed liquidity, the lit liquidity that we see, but they're not exactly a dark pool the way we talk about dark pools and equities. But there's plenty of trading that happens in between that allows better than posted spread execution quality. So we can't just look at that snapshot of where the market's, what the market width is, what the market size is. We also need to think about where trades are actually happening in between that. So getting back to that idea that plenty of data points about what the liquidity looks like overall and in a snapshot, but that experience of how any given execution takes place or series of executions take place is an important part of, it's the top of the liquidity stack, so to speak. Lots of different artifacts that we can look at, lots of different data points that we can look at to come down to this concept of measuring liquidity. And here I have 8 listed. There are easily more, and I'm sure someone has some good ideas for some other liquidity metrics. But taking it at the kind of most simple would be your basic bid-ask spread. And so the difference between the best posted buy price and the lowest sell price, that's a very, rudimentary but informative measure of liquidity. How wide that market is, probably the number one thing I look at first when I'm trying to answer the question of how liquid something is. Right up there with that is going to be quoted size. So we're not just looking at the posted bids and offers, we're looking at how much depth there is. We're looking at overall volume. What is the total activity in this name? How many shares or how many options contracts are trading here is going to be indicative of the future tightness of that bid-ask spread. More volume is going to tighten that up also. But the consistency and availability of future liquidity, volume is a very good indicator of that. Trade count. So it's not just how much volume is happening overall, but are we seeing that volume either concentrated at specific times Or are we seeing that volume take place in large block orders? If you're just trading 10 and 20 lots, you want to see lots of other 10 and 20 lots that are out there trading. You don't want to see one big block order for 5,000 that is making up the majority of that average daily volume. That means it's much less likely that your 10 or 20 lot is going to trade at a competitive price because most of the activity is very concentrated. So it's not just how much activity, but what the kind of size and texture of that activity looks like. Similar to volume, and a unique feature of options doesn't exist exactly with equities, but open interest. That the measurement of how many contracts are outstanding on that line is another really good indicator, both at a series level and in an overall issue level, how much activity has taken place and how many open contracts exist is a very good indicator of the potential for getting a good fill should you need to get out of that trade. The more other people are paying attention to that, so to speak, the better price you're going to get. We talked a little bit about measuring that liquidity through price improvement and execution quality, and how well trades actually are priced when they're executed. Similar to that, in the transaction cost analysis vein, what is the price impact and slippage? So you might see a lot of liquidity on the market, but to the extent that orders come in and trade, and if that liquidity is very skittish, then that's going to be less liquid. So we can't, again, just look at the snapshot, but we need to think about how much these markets move on given inputs and fill rate and the ability to potentially sweep markets. So, to the extent similar to that kind of slippage question, if orders are moving as soon as there's an impact, then that's going to reduce fill rate, and a buyer might not be able to get all the contracts that they thought were offered there because that liquidity is a little bit more skittish. So, paying attention to at what price, in what size, what improvement potentially might happen, and your overall fill rate are kind of important metrics to track on an order by order and aggregate basis as a measurement of liquidity. So we've talked a little bit about the bid-ask spread, and I'll show one right here to dig into even more detail. Uh, I think I used this term before, but I think a really good mental model for the bid-ask spread, including the price and size, is a confidence interval. It's a confidence interval on what the fair value of that security is, and the size is the amount of confidence you have at that level. Showing 200 contracts obviously demonstrates more confidence than only showing 10. And so we break it down. Typically this is how it'll be displayed in a montage, moving left to right, bid size, bid price, fair value somewhere in the middle, ask price, and ask size. So that's fairly common. We see that on any montage, but there are some other ways to think about that other than just the nominal price difference there. It's worth thinking about what the percentage of that contract is. 8 cents on a $50 option is way different than 8 cents on a 10-cent option. So the percentage of the option's price is definitely an interesting way to think about that spread width. But if we really want to dig into it in options trader terms, we might think about what the implied volatility that represents. So this is a really good way to normalize that across both price levels and across different securities also. So we can say that the 150 price here represents a 25.8% implied volatility, such that if you buy that call or sell that call for 150, hedge with underlying stock at this stock price with these interest rate and model assumptions, you are trading a 25.8 implied volatility. At 158, it would be a higher implied volatility. So the spread between those is about 1.4%. And so we can normalize that implied vol clicks across different issues and say something like SPY typically has a vol spread of about zero point 0.2 clicks, where something like tier F biotech pharmaceutical might have a vol spread of 20 implied vol points. That generally is associated with higher implied volatilities, less certainty. Again, the more complicated the situation, the less liquid the underlying, the wider that spread's going to be in absolute terms, in percentage terms, and implied volatility terms. Another interesting point is that here we have a penny decrement, but to the actual decrements allowed in quoting may often themselves have an impact on liquidity. If the decrement is, say, a nickel or a dime in some of the higher dollar issues, then all of a sudden we're going to see liquidity pooling at different levels rather than what, perhaps would be allowed to exist in a penny issue, penny priced issue. I mentioned before, but it's worth remembering that averages don't tell the entire story. That if we're breaking down some of these metrics, we might want to be looking at ADV, which is a great number. You're looking at the market width, you're looking at the average daily volume. These speak volumes about a stock's liquidity. But I have two examples to kind of show the difference between something like ASX, semiconductor stock on the left-hand side, and SPY, arguably the most liquid name in the equity options markets. Uh, the mean volume of SPY throughout this period was something like 7.7 million contracts. The median was something like 7.2 million contracts. We see pretty consistent volume here overall. Sure, there are some big spike days. Without even looking at the dates, you can probably guess when some of those were. The on the most active days, we definitely see a jump in, even the most liquid names. On the other hand, a name like ASX, the mean was something around 3,500, whereas the median was closer to 1,000. And if you look at that, you can see that, the chart's telling a little bit of the story here too, that there are some big fits and starts. And that's not necessarily the same quality of liquidity as we might see with that really consistent number. And so with individual names, sometimes we'll see that concentration around earnings, for example. That names that do a bunch of volume on their earnings day doesn't necessarily mean that's going to be consistently a liquid issue going forward. There are certain names that are big for dividend plays, which is another kind of strategy that will inflate volume and not look and artificially make it look like there's more liquidity than there might really be. Maybe it's just news events that are the reason that surges like that, but looking at the average here isn't exactly the story that you'd expect when we take a name like ASX, for example. So execution quality is one of the ways that we measure liquidity and we measure the experience of liquidity. And this is a very common measurement that is used by brokers when they're discussing payment for order flow and managing retail order flow. So teased a little bit the idea there that retail can get executed inside the spread, and execution quality is what measures where within that spread they're getting executed. So overall, a really good thing to think about from the buy side perspective, from the individual trader's perspective here, is that if I see a market that's 150 at 158, the midpoint might be 154, and if we can assume that that sort of midpoint represents fair value, you don't necessarily have to go all the way up to paying 158 if you want to get long this trade. You can expect to get executed probably closer somewhere to 155 or 156. And in this case, 156, assuming that's where that execution takes place, that represents a 50 EQ because zero would be the midpoint. If you got a zero EQ, that would mean you got perfectly filled at the mid. There was, no slippage at all. Up to 100 would mean you pay the ask. And that's, obviously not the best scenario. But, you hope those markets are tight, of course. But anyway, going for that 50 EQ level, knowing that that's about where things trade, I think that's a really good kind of anchor when you're looking at wider markets for where you should expect to get filled. And so the difference between 154 of zero, 158 of 100 gives, 4 cents, 2 cents of price improvement off that gives that a 50 EQ. This is often aggregated across, I shouldn't say often, it's usually aggregated across all the different orders over time. So all the different pennies you save from the spread are aggregated and then compared to the overall spread that is available. So thinking about tracking this over time and observing, not necessarily encouraging everyone to kind of keep a spreadsheet of exactly what the markets were and exactly where their fills were, but that's something to, if there are names that you're trading regularly, kind of tracking that in your head. Where am I seeing fills here? Because, on any given security, where that execution quality lands is going to be somewhat different because of different demands in the underlyings, the series, every option is obviously unique. And so tracking where you're getting filled is a good way to continue to anticipate that going forward. So similar to the measurement of execution quality is transaction cost analysis. And so transaction cost analysis, something that can be done both with equities or with options. And this is aggregating all your executions over time and breaking it out into a couple of different components. If we decide to trade at 9:30, the arrival price, as it's referred to, is this is a stock example here, but same thing can be done with options. Is that it arrived, stock was trading $100. If you're buying that stock over time, say you have a bigger order than is displayed, or you want to, slice that order up over time to kind of reduce the impact, you might execute over a 10, 15, it could be 30 minutes, or it could be 2 minute period. If overall your average price ends up at $100.12 and you paid fees of a penny and transaction costs of a penny, regulatory fees of a penny and transaction costs to the exchange or broker or whatever of a penny, your all-in shortfall would be 14 cents. Meaning at the time you expected to pay 100, you slipped up 12 in terms of slippage against the actual execution price, and then you paid two more pennies in terms of your other fees. That shortfall is definitely something to continue to monitor. Paying up 12 cents on this is 12 cents you'd rather have in your pocket. And over time, that adds up, of course. And so a lot of what equity and equity options algorithms are trying to do is minimize that shortfall. Because as a buyer, especially of any moderate size relative to that name, you're going to push the price against you. And as we see, it falls off pretty hard right after. There's a little bit of an exaggeration, but if we see an end price, whether it's at the end of the day, whether it's at the end of the, an hour later, T plus 30, T plus 60, we say, okay, it reverted back down to 100.5. So the buying pressure drove it up to 12, but really it stabilized at 100.5. So that post-trade reversion of 7 cents is also something that we monitor. More liquid issues will have smaller shortfalls and smaller reversions. Orders that are less likely to overtake the liquidity in a name are also going to have lower reversions and shortfalls. And I say that because liquidity is very much a relative concept. That the same order size in Johnson and Johnson is not going to be the same as what happens in SPY. If you send 10,000 contracts down in SPY, that'll get eaten up very quickly. If you trade in a less liquid name and show up with 10,000 contracts, that's a whole different story. So, keeping to my tight 35, 40 minutes we're going on here, I'm going to cut it there and tease what is next. Because we've talked a lot about all the different measurements of liquidity and kind of set the foundation for what this theoretical experience, the liquid experience is. That's a plug for the till, last week's till on the liquid experience. But kind of framing what that ability to get in and out of that trade and how to price things that are on your sheets. From here, we'll probably move into how liquidity impacts strategy selection, how that impacts ticker selection, and how that impacts which names you choose to trade. So I appreciate everyone paying attention today. I didn't get any questions in line, but I'll pause and see if we have any questions from the group. Nope. I think I overwhelmed everyone with my arcane discussions of liquidity. But seriously, if you do think of any questions, if you're watching the recording that'll be posted shortly, or feel free to email me with questions. Again, that's Mark at harvestedfinancial.com. And excuse me, I'd be more than happy to answer any of your questions. Thanks again for tuning in. Be sure to check out the tape.report, where we have all kinds of strategies, all kinds of options, research tools, many of which lean on some of the liquidity stuff. So join us in Slack, join us at the tape, join us on YouTube. I appreciate everyone's attendance and watching here. So thanks very much, and have a wonderful day.